We start tonight with the state of the American job market. The unemployment rate currently stands at 6.2%, down from a high of 10% back in 2009. But despite making progress, Federal Reserve Chair Janet Yellen recently said, quote, "There's still more that needs to be done." Hampton Pearson has more.
The job market is improving, but there is still lots of work to do. Jackson Hole Fed Chair Janet Yellen called the employment picture hazy. On her short list of concerns, reducing long-term unemployment and increasing the prospects for higher wages for those with jobs.
Chair Yellen has made it very clear. She wants to see wage gains. And until she sees wage gains and the proof in the pudding, she's not going to pull the trigger on raising rates in this economy.
Headline unemployment, now at 6.2%, is down more than a full percentage point in the last 12 months. While the economy has regained the nearly 9 million jobs lost since the recession, millions of Americans are working for far less money. The two sectors that lost the most jobs, manufacturing and construction, where the average pay is about $60,000 a year, are still about 3 million jobs short of a full recovery. Meanwhile, job growth accelerated among lower-wage workers in the restaurant, hotel, and healthcare sectors, according to an economic analysis from the U.S. Conference of Mayors.
There are a lot of people out there who are saying, what do you mean an improving economy? What do you mean the recession is 5 years in the rear-view mirror? My paycheck is still flat.
Figuring out just how much slack remains in the job market and getting those who have chosen not to participate back in the game is perhaps the biggest challenge.
The biggest losses in labor force participation have been in young people, not just high school students and people in their 20s, but that sort of really the prime earners out there and the people who are in the prime of their career, the 35 to 44-year-olds. And that's where you really got to bring people back in again.
Here in Washington, we know that employment is half the mandate for the Federal Reserve. But heading into the fall elections, expectations for action on major jobs initiatives from Congress or the White House have never been lower. For Nightly Business Report, I'm Hampton Pearson.
We turn now to Joe Davis to talk about the American job market. He's the chief economist at Vanguard, the giant mutual fund firm. Joe, nice to have you with us on this holiday show. I want to start off by just asking you about what are you expecting this Friday when we get the Labor Department reporting the latest the employment report. Are businesses hiring, and are they hiring more than we've seen over the last couple of months?
Well, I actually think so, Susie. I mean, I think we'll see continued strength. We've seen that for several months now, and in fact, particularly relative to past year. The U.S. labor market is tightening, although it is far from tight. But the momentum that we see, not only in the pace of job creation, but also the breadth of jobs. More industries are adding jobs than they had in the past. And so I think that all sums up to a fact that we will continue to see modest but strong momentum in the labor market.
Mm-hmm. The number that everybody always focuses on is on this unemployment rate. Right now it is 6.2%. If the momentum continues, as you're saying, where do you expect that number to be, let's say, by the end of the year?
Well, I think the main expectation is around 6% if you ask the Federal Reserve and many other economists. I think the clear risk is that the unemployment rate is below 6%, the official rate, before the end of the year. The biggest reason for that, if we continue to add jobs at the recent pace that we have been in the United States, it is unlikely that we will see, although possible, unlikely we will see the rapid increase in labor force that would be needed to offset those gains and to keep the unemployment rate above 6%. So I think clearly the risk is by the end of the year, the unemployment rate stated is at the high 5% range.
Mm-hmm. The other frustration, and you heard it in Hampton's package, is that quote that people say the economy is improving. Well, I don't see it in my paycheck. I mean, wages have just not moved. Do you see any change in that? Will we see people's paychecks growing a little bit?
Well, I think 2 points. One, it's actually a fair point. I mean, wage growth, as we all know, has been around 2% on average for the past 4 years, despite a rapid decline in the stated unemployment rate. That said, we are seeing small changes. I think not so much in industries that are rapidly increasing pay. They're very small in number and a share of the economy. Information technology is an often cited example. However, we are starting to pick up are those industries that had the flattest wages or no wage growth at all, even cuts in pay in hours, such as construction and retailing. We're starting to see those industries gravitate closer to 1 or 2%. So arithmetically, we would expect to see a modest firming in wage growth from this 2% level to say 2.5% to 3% early next year. And I think that's important because I think the Federal Reserve will be reluctant to raise rates until they see those wage gains.
Now that you bring up the Federal Reserve, I mean, one of the points that keeps coming up when policymakers are talking is that a lot of the problems in the job market are structural, that those jobs just aren't coming back. This is the new normal, so to speak. Others say, no, this is just an economic cycle, and once the economy gets better, the jobs will come back. Where do you stand on that? Because that's a critical question and answer that'll determine what happens with interest rates.
Totally agree, Susie. We've done a lot of work on this. We're actually right down the middle, and it's not a shortcut. There's clearly a cyclical element, which means if we see stronger demand, higher wage gains, some Americans who are temporarily out or currently out of the labor force will return. But there's also clearly a structural impediment, and it's not just demographic forces that have kept labor force participation rate down. It's also things such as potentially skills mismatch, the rise in disability, which at least historically have not tended to follow or return to the labor force in such rapid pace. So as we calculate the numbers, it's roughly 50-50. So the good news is that for those that are savers or investors out there, it means a little bit less slack in the economy and slightly higher pressure on wages for those that do have jobs. The downside, however, is that the potential growth rate for the economy is a little bit weaker than some would have thought just a year or two ago.
All right, tough situation for especially out-of-work Americans. Thank you so much, Joe, though, for coming and giving us your views on everything.
Thank you, Susie.
Joe Davis of Vanguard.